Okay guys, I'm back again with another video. So today I'm just going to be explaining a few things. Basically I'll be explaining what buying low and selling high is, and how best it can guide you on your entries, and how to manage your risk in terms of placing your stop loss and all of that. Okay, so this example that I have here on the screen is an uptrend. As you can see, we're making higher highs and higher lows, higher highs, higher lows, higher highs, higher lows. Price is pushing up. So this is an uptrend. So what I would recommend you guys to do is to only buy in an uptrend and only sell in a downtrend. So we are not looking for sells in this market. We are looking for buys, because sells are pullbacks. So price, as I mentioned in my previous videos, price doesn't move in a straight line. Price doesn't just go from here going up. Okay, price will move in this manner. If it's an uptrend, it goes up, then it pulls back, goes up and pulls back like that. Okay, so in an uptrend we are generally looking for pullbacks, and we enter and buy low. So when price got to this point, it came down to pull back. Okay, that was the first higher low. Then it made a higher high here. So our entry ideally would be after it pulls back. If you check here, we have several confluences that we can have. We have a level here. Okay, we have a level here. All right, so this is just an illustration. In the markets, things can look different and you can have different confluences. For example, I sent you guys chart patterns. So this can be a chart pattern here. Okay, this can be a flag. I sent you this in the group, guys, so you should know what that means. So this can be a flag. Okay, so you look for your entries somewhere here. All right, when price is touching this high for a retest and price has made a flag, which is a continuation pattern, then you look to enter somewhere here. Okay, I've also sent to you information about candlesticks. So to enter here, you can use candlesticks that confirm that the price is reversing and continuing the impulse leg. As I said on my previous comment in the group, that this is an impulse leg, this is a correction, this is an impulse leg, and this is a correction. So when price is moving in a corrective manner, you can determine that it's loading to go back up. So there's a difference between an impulse leg and a correction leg. For example, on Euro card that we were talking about in the group just now, it's making a very clear flag going down. And if you check the previous move the market had made, was a very strong push to the upside, which was an impulse leg. And when it was going down, it wasn't as fast as it did when it was going down, when it was going up. So that was an impulse, and now it's making a correction. We look for candlestick confirmations here, and this is a flag, which is a candlestick, which is a chart pattern, which tells us that the price is just loading to continue its impulse leg. Okay, so I want to tell you about buying low and buying high. Okay, the difference that it makes. Okay, so if we buy here, we bought low because it made a lower low. We buy here. And now I'm going to explain what buying high is. So what most people do is they see price moving up and it breaks this resistance over here. Okay, and it breaks this resistance over here, and they start buying here on the breakout. Okay, so let me remove this. People start buying over here on the breakout, and look at where the stop loss will be, below this low. See how big this stop loss is, and their target profit will be very high. Okay, so this stop loss is too wide. We want to avoid stop losses that are as big as this. We want to try by all means to place our stop loss just below the previous support. Okay, so the ideal place to buy would be here, and our stop loss comes below the support, which is here. This is a very manageable stop loss, and we have room for price to push up. So someone can take their profit here when price makes them equal high, and they take their profit here, which is very good. or someone will be expecting price to break. Since it made an impulse here and a correction, price is likely to make the same size impulse here to continue this bullish pattern. So someone can just measure from here to here, okay, and clone this and put it somewhere here. Then you see where price is going. That's where they put their target profit. Okay, that's a better entry here. So you don't buy over here when it breaks that level. Your stop loss will be very big. I hope you guys are understanding this. Okay, then there's another person again who would want to look for price moving up. Then they think of buying when the price breaks this resistance. Okay, they think of buying there, then they hesitate, they don't buy. So we have an early entry which was here, then the late entry is here. Okay, and price is likely to move up, and you move your stop loss to break even. Price is likely to move up like that, and you move your stop loss to break even, and price comes back now to retest this support. The resistance becomes support. Okay, price broke it, it's likely to come and retest it. So if you put your stop loss over here, guess what? You're tagged up and price moves up. But if you enter early, like we had said, price moves up. Okay, you move your stop loss to break even. Price will not come and retest here because it has already done it. But if it moves back, it means price might be reversing and continue going down. So you'll be safe anyway. All right. So there's the early entry or ideal entry. Then there's a late entry. Then there's a bad entry. A bad entry is when someone is seeing that they could have bought it here. They could have bought it here first. They missed it. They could have bought it here, which is what we don't recommend. And they see it going up and they're like, price is going up, it's going to continue going up. Then they buy here. Okay, this is a very bad entry. So their stop loss, probably they would want to put it here, but the idea is price has already made an impulse leg. So if you buy here, you are buying late. So price is going to pull back and you're going to be in drawdown, and you're going to be seeing a red dash on your balance. Okay, and which is psychologically not good. Okay, and you can either place a stop loss here or down here. So either way, the stop loss is just too wide. Okay, we want to enter when the stop loss is very tight. So you don't buy here because price can easily pull back to this level and can change its direction and start going down, and you would have made a loss. So do not buy when price is high. So from this illustration that I made here is when price is in an uptrend, we want to buy when price is low. Okay, then if you sell pullbacks, you want to sell when price is high. Okay, if it makes it an impulse leg, this is a better place to sell. Okay, because price is likely to go down. But these entries are the ones that I do not recommend. So when it's a downtrend, I would recommend entries like these ones. It's just the opposite of what I was explaining. So let me just delete these. Okay. Okay. So if price is in a downtrend, if it's moving like that, okay, lower high, lower low, lower high, lower low, and so forth and so forth. Okay. So this is a downtrend. So we are looking for sales. The best place to sell that I can see is here. Okay, put your stop loss just above this resistance. Your target profit, maybe target profit 1 at this level at the equal low, and the next target probably down here at the next impulse of this leg. Okay, take that, clone it there, then your target profit is right there. Okay, so it has completed that impulse, correction, impulse, correction. It's moving in a downtrend. In this instance, like I explained, if you want to sell, you sell at this point. You sell at this point, okay, and also sell at this point, and also sell at this point. Okay, these are the points you sell when price has made a lower high. Okay, this is a lower high, this is a lower high, this is a lower high. So this is where you try to look for your entries. You do not sell anywhere here. I hope I've explained this well. You do not sell anywhere here. You do not sell anywhere here. You do not sell anywhere here. So do not fear being left out by the markets, because what causes people to sell low is when they fear that the market is leaving without them. If it has gone, it has gone, accept it. Just wait for a pullback, then you enter nicely to go down. So risk 1% per trade. You lose this trade. You lose this trade. You lose this trade, okay? You win this trade. You win this trade. Okay. So this is 1% of your account that is risked, but you gain 4%. As you can see, this is 4. You gain 4%. Okay. So you have 4% profit. Then you enter here, make a stupid decision and enter here. Then it hits your stop loss. This is 1%. Remember, we risk 1%. The red part is the risk. The red part is the risk. Then the green part is the reward. So the reward here is 4%. As you can see, it says 4.02. Okay, so you calculate. I taught you in the previous videos how to calculate percentages. So this is 1%, this is 4%, so you have 4%. Then when you lose this one, you lose 1%. Okay, so you're still net plus 3% of your account. So if you manage your risk and remove fear of being left by the markets and enter only when price gives you a pullback, in the long run, you'll be still a profitable trader. So I hope this video has helped you guys, and I hope to see you soon in the next video. Cheers, guys.